how things, especially the markets, really work. If you've ever traded or even just watched the financial news, you've definitely heard the term smart money.
Hmm.
And it's always talked about like it's this mythical force, some anonymous, all-powerful group moving trillions around behind the scenes.
Well, that anonymity is very much intentional.
Yeah.
But the power behind it is absolutely real. So our mission today with this deep dive is to really pull back the layers, not just on who these players are, but on the actual systematic mechanics they use.
The nuts and bolts.
Exactly. We've got through the source material to give you three core things.
Mhm.
First, the actual roster of these institutional giants. Second, the just overwhelming scale of their financial power.
And the third.
And this is the most crucial part, the specific strategy they use to move price. And I mean, it is fundamentally different from what 99% of retail investors are ever taught.
Okay, that strategy difference, that feels like the whole pivot point here. It probably explains why so many market moves just seem, well, completely illogical to the average person.
It explains almost everything.
So let's unpack this. Who exactly are these behemoths with the power to literally define market direction? And what's the hard evidence that confirms they're really in charge?
Right. Because when people say the market, they are, for the most part, talking about this very select group.
And the rest of us are just kind of along for the ride.
Precisely. So when we define smart money, it's less about, some individual genius trader and more about their collective scale, the privileged access that comes with it.
Okay.
Our sources break this group down into five distinct categories.
Let's run through the lineup then. The first couple are probably the ones everyone thinks of, the institutional heavyweights.
Right.
You've got the banks, and we're not talking about your local community bank here.
No. These are the major investment banks, the global financial institutions, their trading desks, command capital that just, it dwarfs the economies of entire countries.
And right alongside them, you have the hedge funds.
The aggressive players, yeah. They're all about using these highly complex, often proprietary trading models. They execute these massive, high-stakes trades.
So they don't just react to the market.
They often impose the market conditions. That's a great way to put it.
Okay, so beyond the big company names, we have the people inside them, the institutional traders.
Yes, the human decision makers.
Yes.
They're armed with infrastructure and access that you and I can't even imagine, executing these multi-million, sometimes multi-billion-dollar orders in seconds.
Based on data we just don't get to see.
Exactly.
Yeah.
And then you have the last two, which are the critical cogs that make this whole machine run.
The liquidity providers and the market makers.
Mm-hmm.
And I think these two terms get kind of jumbled together a lot, but for understanding the smart money strategy, we really need to know the difference, right?
Yeah, we do. There's a fundamental functional distinction between them.
So what is it?
Okay, think of it like this. Liquidity providers are like the wholesale dealers. They're the ones who make sure that when a huge bank needs to suddenly sell, say, 5 billion euros,
Right.
that there's a mechanism to actually absorb that sale quickly and smoothly. Their whole role is about availability, having these deep pools of capital ready so the market doesn't just freeze up.
So they're making sure the trade can even happen without the whole engine seizing.
Exactly. Whereas the market maker is your constant price setter. They are always continuously quoting both a bid, a price they'll buy at, and an ask, a price they'll sell at.
And they make their money on the spread between those two.
A tiny little spread, yeah. They basically guarantee that volume exists, which is absolutely essential for these big institutions who need to get in and out of positions instantly.
What's really fascinating here is that this whole group, from the global banks all the way down to an individual market maker, is defined less by their specific job and more by just their collective scale. And that scale, as we're about to see, isn't just influential. It's functionally overwhelming. They're playing a completely different game.
And that's a vital point. Because of the size of their orders, they have a problem smaller traders never even think about: slippage.
Right. If you try to buy too much at once, you push the price up against yourself.
Exactly. If you try to execute a $5 billion buy order in a thin market, the price will just shoot up against you and your average entry price will be terrible. So this need to manage slippage, that's what dictates their entire strategy. And it all goes down to finding colossal pools of opposing orders.
Finding liquidity.
Finding liquidity.
Speaking of colossal, this is where the sources move beyond definitions and just put the size of this whole thing into stark context. We have to look at the evidence of their dominance, especially in the biggest market in the world, foreign exchange or FX.
The numbers here are pretty staggering. The sources state that this group we just defined, smart money, they account for 75% or more of the daily FX volume.
75%. That's not a majority. That's a directional lock on the market.
It's an over countries like Japan or Germany.
Trading hands every single day.
Every single day. So when one group of players controls 75% of that daily flow, their movements aren't just influential anymore.
They are the market. If they move, the market moves. End of story.
That's it.
Okay, but here's a question then. If they're so dominant, if they control 3/4 of the flow, why isn't the market just perfectly smooth? Why do we still see these intense, rapid bursts of volatility that seem to come out of absolutely nowhere?
That's where the link between that scale and their behavior gets really clear. The sources detail how this happens, specifically pointing to hedge funds.
Okay.
Because of their highly leveraged, multi-billion-dollar positions, they are a key factor in driving that kind of localized volatility.
How does that actually work, though? Are they trying to create chaos on purpose?
No, it's not malicious chaos. It's really just a result of relentless efficiency.
What do you mean?
Because their orders are so massive, they are constantly hunting through the market structure for liquidity, for those pools of available buyers or sellers, so they can execute their trades with minimal slippage.
Right.
So when a major fund drops a multi-billion-dollar order into the system, that action is the volatility we see on the charts. They introduce this intense, localized pressure as they hunt for a place to fill their books.
So those sudden, sharp drops or spikes, the ones a retail trader sees and assumes is a reaction to some news headline. That's often not a reaction to volatility. It's the market just trying to absorb a huge institutional trade. The institution is pushing the price to where the orders are.
Precisely. Their own internal operational necessity, that search for efficiency, is what creates the market behavior that we all see from the outside.
Okay, so we know who they are, this defined institutional group. We know how much money they control, trillions, daily. So here's the crucial part. If they aren't looking at the same technical indicators everyone else is, how do they decide where to move the price? What is their core strategy?
This right here is the fundamental paradigm shift. If you take only one thing away from this entire deep dive, let it be this core principle. Price moves on liquidity, not indicators.
I mean, that one sentence basically invalidates the focus of most online trading education.
It really does.
We're all taught to obsess over moving averages, Fibonacci, oscillators, all these patterns, try and predict the future.
And that's the trap. Retail traders look at historical data to try to predict future value. Smart money is focused on one thing and one thing only. Where is the available money right now? Where are the clusters of buyers and sellers sitting and waiting?
They see the chart as a map of liquidity.
Exactly. Not as a historical price log.
So give us an operational example of that. Let's say a major bank has a huge sell order it needs to fill.
Right.
They can't just hit the sell button now because the price would collapse against them. They need a deep pool of buyers to sell to.
Exactly right. And that brings us to the operational reality the source outlines. Large orders fill liquidity zones. They use algorithms to find specific price areas where they know a high volume of orders is clustered. And these clusters, these liquidity zones, that's where they can execute their huge trade efficiently.
So the price moves to that zone because the institution needs to trade there, not because some indicator line just crossed.
Yes, the movement itself is just the necessary journey to get to the destination of efficiency.
The movement is the goal.
And this leads us to the most controversial, but maybe the most illuminating tactic documented in the sources, the one that directly impacts smaller traders.
And what's that?
Algorithmic targeting of retail stops.
Wait, targeting is a very strong word. Are you saying there's evidence that these institutional algorithms are specifically designed to push prices just far enough to take out smaller traders? I mean, that sounds incredibly cynical.
The analysis doesn't really frame it in ethical terms so much as mathematical efficiency. Retail traders are, creatures of habit. They use predictable technical analysis.
And because of that, they place their stop-loss orders in predictable places.
Exactly. Just below a recent low or just above a recent high. It's textbook.
And those stop-loss orders are the key because when they get triggered, they instantly become market orders. They have to be filled immediately, no matter the price.
Precisely. And those triggered orders create a perfect, readily available, guaranteed pool of liquidity that the institutions can then absorb.
So the algorithms aren't trying to predict the future trend.
No. They're designed to push the price just far enough to sweep those collective stop-loss orders. They capture that sudden rush of liquidity, they fill their massive position efficiently, and then what happens?
And then the price often reverses immediately, leaving the retail trader stopped out and just completely mystified.
That is the classic stop hunt.
I've seen that on a chart 1,000 times. The price pierces a key level by just a few pips, reverses, and then goes exactly where you thought it was going to go in the first place.
And that little moment, that piercing move, that is the institutional execution. It's the monetization of predictable behavior.
So if we connect all this to the bigger picture, it means the short-term price moves we see. They're often not random. They're a calculated search for the best place to execute an immense trade.
Which really raises an important question. Are daily market movements truly reflective of fundamental